Welcome to our second edition of Financial Literacy. In the first edition, we introduced the topic of personal debt. We looked at what constitutes a personal debt. And today we want to look at what the impact of technology is on debt, on personal loans in Kenya. And we are actually going to be looking at some of the statistics based on the 2019 Financial Access Survey conducted by the Central Bank and Financial Sector Deepening Trust in 2018. If we look at the numbers, basically mobile technology has really helped to improve financial inclusion, because in 2006, financial inclusion in Kenya was at 26.7%. But as at 2019, it was up to 82.9%. And this is thanks to mobile technology. Now, in 2017, 13.6% of all adults had taken digital loans. Basically, about 3.42 million adults had taken digital loans. And of course, given the high rate of adoption of the digital credit, we expect that in 2019, the numbers have grown significantly. So those numbers should be much higher by now. And in 2018, according to 2018 statistics, each of the digital borrowers had taken on average 8 digital loans in 1 year. And we also see that digital loans are the most common type of loan that people take when you today in Kenya, when you compare with other sources of personal loans like families, friends, or traditional sources of funds like banks, chamas, microfinance institutions, SACCOs. Digital loans, because of their ease of access, have become the most common source of personal loans. And the average size of a loan, a digital loan that people are taking in Kenya, is between 4,500 and 7,300. Basically, about $45, between $45 and $73. That's the average size of a digital loan that most people are taking. And this constitutes up to 60% of the income of the people who are taking these digital loans. And because the mean income of the people taking the digital loans is about 18,300 shillings to 25,600, in the range of 25,600 shillings, which is about $183, $256. That's the range of the income of the people, majority of the people who are taking the digital loans. And how are people using these loans? How are people using the money they take from the loans? Majority of the people of the loans are being used to meet day-to-day household expenses. As high as 44% of the money taken from digital loans is spent to meet day-to-day expenses. And the rest, 29%, goes to emergencies. And in terms of debt repayment distress, nearly 50% of the digital borrowers reported having to either sell a personal asset to repay the loan, or borrow from another lender, another mobile app, to repay one mobile app. So up to 50% of the borrowers at one point or another were in repayment distress. And the default rates are high compared to other traditional loans. The default rates are over 21%, which is a really high default rates. And so what do we gather from this? We see that this form of unregulated borrowing and lending environment has caused a lot of distress. A lot of people now, as at July 2019, we saw that up to 2.7 million Kenyans were already listed with the credit reference bureaus. What that means is that they will not be able to access credit for several years. And a lot of these people, up to 400,000, were listed for loans of just about 200 shillings. So we really need an environment that can nurture responsible borrowing and responsible lending. Because and this is where the regulators need to come in. And I'm glad that recently the central bank has said that they are going to come up with regulations to guide how digital lenders operate, because obviously self-regulation has not worked. I mean, digital lenders need to think about the opportunity that technology has presented to give loans. They need to look at it from a long-term perspective. Because if you give someone a loan at an interest rate of, some of them, the interest rates are as high as 27% per month, which translates to about 324% per annum. I do not know what legal business you expect the borrower to engage in to be able to gain enough income to be able to repay that loan, and then also have some surplus for themselves, which means ideally at the point when this loan is being advanced, it's already set up for default, because there's absolutely nothing that this person is going to do to be able to generate enough money to be able to comfortably repay that loan. And if digital lenders say that then the reason for such high interest rates is because of the risk profile of the borrowers, then my view is that if you have scored a borrower, a potential borrower, and their risk profile is so high that you need to raise the interest rate that much to be able to cover yourself, then it means that that person should not be eligible for the loan. Do not give the loan, because giving loans at such high interest rates, and when you look at the profile of the borrowers, I mean, these are basically the poor who traditionally have been excluded from the financial system. But now with technology, with mobile technology, they have access. But what is the kind of access if then it's going to take away the little that they have and basically subject them to debt cycles, which just cause the poverty levels in that segment of the population to keep increasing? I think there's need for responsible lending, as there is need for responsible borrowing. And I'm looking forward to the kind of regulations that the central bank is going to put in place to ensure that digital lenders can lend responsibly. And because technology should be used for good. Technology is not bad. It should be used for good. It's just like medicine. If you, medicine can be used to cure illnesses, but medicine can also be abused. If you take an overdose, you could potentially die. And that's the same thing with technology. It can be used for good or for harm. And I'm hoping that we are going to see a transformation in the fintech space, where borrowers start to give loans in a responsible manner, reasonable interest rates that ensure that the borrowers can come back again and borrow, and they are also the financial status is improving, and we are growing the economy. And so this is what we are encouraging. If you have questions or you have a topic that you would like us to address as far as financial literacy is concerned, we would be very glad to hear your views. Please kindly contact us and share your views. Thank you.